American investors are doing something they haven't done in over 16 years. They're pulling money out of U.S. stocks at record speed, $75 billion in just 6 months. After decades of buying America, something fundamental is shifting. What's driving this exodus, and what does it actually mean for the markets? Let's break it down. Welcome back to the channel. I want to be crystal clear. This video is for educational and informational purposes only. Nothing here constitutes financial advice, and I'm not telling you what to do with your money. We're simply analyzing what's happening in the markets right now based on recent data and helping you understand the context. Over the past several weeks, financial data has revealed a significant pattern. U.S. domiciled investors are withdrawing from domestic equity funds at the fastest pace since at least 2010. According to LSEG and Lipper data published on February 20th, 2026, $52 billion has flowed out of U.S. equity products since the start of this year alone. This isn't a story about panic, it's a story about reassessment. So let's understand what's actually happening. Let's start with the facts. According to recent fund flow data from multiple sources, including Reuters and Morningstar, here's what we're seeing. In the last 6 months, U.S. investors have pulled approximately $75 billion from U.S. equity products. The pace accelerated in early 2026 with $52 billion exiting in just the first 8 weeks of the year, the most significant early year outflow since records began tracking this metric in 2010. January 2026 alone saw U.S. equity funds shed $34 billion, according to Morningstar's fund flow commentary. This continues a longer-term trend that has persisted over the past 9 months. Meanwhile, mutual funds experienced notable redemptions. The Investment Company Institute reported that long-term mutual funds saw net outflows of $23.34 billion in the first week of January, with equity-oriented strategies bearing the brunt of withdrawals. But here's what's interesting. This isn't just money leaving the market entirely. Much of it is being redirected. U.S. investors have poured approximately $26 billion into emerging market equities so far this year. International equity funds attracted $31.5 billion in January, their 9th consecutive month of inflows. That's their strongest monthly intake on an organic growth basis since March 2021. European equity products have received nearly $7 billion from U.S. investors since January 2025, a stark contrast to the $17 billion outflow during President Trump's first term from 2017 to 2021. The destinations are telling. South Korea has been the largest single-country recipient, with $2.8 billion in inflows, followed by Brazil with $1.2 billion. Diversified emerging market funds saw a record $15.4 billion inflow in January alone. This represents what some analysts are calling the Great Global Rotation, a fundamental shift away from U.S. equity concentration toward international diversification. Institutional investors tell a complementary story. According to State Street's Institutional Investor Indicators for January 2026, institutional investors ended the month with equity allocations at their highest levels since October 2007, but their appetite for specifically U.S. dollar-denominated fixed income assets remained weak. Bank of America's February Fund Manager Survey revealed that global investors switched from U.S. equities to emerging market equities at the fastest rate in 5 years. So we're not seeing a flight from risk entirely. We're seeing a geographic reallocation of where investors believe the best opportunities exist. Now let's dig into the why. There are several interconnected factors driving this shift, and understanding them helps us see the bigger picture. Let's talk about valuations, because this is where things get interesting from a historical perspective. The S&P 500 currently trades at approximately 21.8 times forward earnings, according to data from FactSet and Macro Micro as of mid-February 2026. To put that in context, European stocks trade at roughly 15 times forward earnings, Japanese stocks at about 17 times, and Chinese stocks at approximately 13.5 times. The so-called Buffett indicator, the ratio of total market capitalization to GDP, which Warren Buffett himself called probably the best single measure of where valuations stand at any given moment, currently stands at 219.7% as of February 21st, 2026, according to Guru Focus. This is significant. Historical data shows that when this ratio exceeds 165%, the market is considered significantly overvalued, based on decades of measurements. The current reading of 219.7% is near the highest point ever recorded, which was in January 2026 at approximately 220%. What does this mean practically? According to the same valuation framework, the U.S. stock market is positioned for an average annualized return of negative 0.3% over the next 8 years from current levels. That's not a prediction. It's a statistical estimate based on historical mean reversion patterns. Am I saying the market will definitely go down? Absolutely not. Valuations are terrible short-term timing tools, but they do matter over longer periods, and starting from elevated levels historically correlates with lower future returns. Throughout 2024 and 2025, the AI narrative drove massive gains in mega-cap technology stocks. Companies like Nvidia, Microsoft, and Meta saw extraordinary appreciation as the market priced in the transformative potential of artificial intelligence. But early 2025 saw what some call the DeepSeek shock. A relatively unknown Chinese AI lab released models that achieved results comparable to Western frontier models, but reportedly at a fraction of the cost and using less powerful chips. While the initial market reaction was severe, Nvidia lost nearly $600 billion in market value in a single day. The company and sector recovered. However, the episode raised important questions about the sustainability of massive AI infrastructure spending and whether returns would justify the costs. As we move through 2026, investors are becoming more selective. The easy money from broad-based AI enthusiasm has moderated, and there's increased scrutiny on actual monetization and profitability timelines. This doesn't mean AI is a bubble about to pop. It means the market is maturing and becoming more discerning about which companies will actually benefit. The Federal Reserve's monetary policy stance plays a crucial role. In January 2026, the FOMC held its benchmark interest rate in the 3.50% to 3.75% range. According to the Fed minutes released in February, there was little appetite for rate cuts among officials, with significant internal debate about the appropriate policy direction. This matters because higher interest rates make future corporate earnings less valuable in present value terms, as Warren Buffett has explained. Interest rates act on financial valuations the way gravity acts on matter. The higher the rate, the greater the downward pull. With rates remaining elevated and the Fed signaling patience rather than aggressive cuts, the gravitational pull on equity valuations continues. Here's something counterintuitive. The US dollar has declined approximately 10% against a basket of currencies since January 2025. Normally, a weaker dollar makes foreign investments more expensive for US investors, which would discourage international diversification. Yet U.S. investors are pursuing international opportunities despite this headwind. This suggests the shift is driven by fundamental reassessment rather than currency opportunism. The weaker dollar does provide one benefit. Dividends and returns from foreign investments, when converted back to dollars, get a boost from favorable exchange rates. The United States now accounts for over 60% of global equity market capitalization, roughly double its share in the late 1980s. Within the U.S. market, the 10 largest companies in the S&P 500 represent approximately 40% of the index's total market cap. Many investors are realizing their portfolios have become far more concentrated than they intended. As Kiplinger's recent analysis pointed out, only one of today's 10 largest U.S. companies, Microsoft, held that position a decade ago. Market leadership rotates, always has, always will. And extended periods of dominance in one geography or sector are historically followed by leadership emerging elsewhere. Let's look at performance. Over the past 12 months, the S&P 500 has risen approximately 14%. That's solid. But in dollar terms, Tokyo's Nikkei is up 43%, Europe's Stoxx X 600 has surged 26%, Shanghai's CSI 300 has returned 23%, and Seoul's Kospi has doubled. European banking stocks, to take one example, surged 67% in 2025 and are up another 4% so far in 2026. UBS's head of European equity strategy, Jerry Fowler, noted in February 2026 that U.S. wealth advisors were telling him, they're all talking about investing more offshore because at the end of the year, they looked at the performance of foreign markets in dollars and they're like, wow, I'm missing out. So what does all this actually mean? Let's separate signal from noise. First, what it doesn't mean. This is not necessarily a harbinger of an imminent U.S. market crash. Fund flows are just one data point among many. Markets can remain elevated for extended periods, and there are plenty of scenarios where U.S. equities continue performing well. Investor sentiment, while cautious, hasn't collapsed. According to Motley Fool's 2026 Investor Outlook Survey, 58% of individual investors still plan to buy more stocks in 2026, with only 4% planning to reduce exposure. What the outflows do reflect is a maturing perspective on global diversification. For over a decade, the home bias trade worked brilliantly for U.S. investors. Staying concentrated in domestic stocks, particularly technology, delivered exceptional returns. That trade may not be broken, but it's becoming more crowded and expensive. As Laura Cooper from Nuveen explained, investors are increasingly looking at the global landscape from a valuation perspective, noting the cyclical growth pickup predominantly in Europe and Japan. Starting valuations matter over multi-year periods. An S&P 500 trading at 22 times forward earnings with GDP growth around 5% offers a different risk or reward profile than the same index trading at 15 times earnings. Meanwhile, international markets offer exposure to different growth drivers: Europe's defense and infrastructure spending, Japan's corporate governance reforms, and emerging markets' demographic and digitalization trends. History shows that market leadership rotates. The U.S. cannot outperform indefinitely simply because it's the U.S. Over long enough periods, valuations matter, and cheaper markets tend to close the gap. As Kevin Thozet from Carmignac Investment Firm noted, what we might be witnessing is this idea of a great global rotation from a very long-term perspective. There's also a structural element worth noting. While traditional active mutual funds are experiencing heavy redemptions, exchange-traded funds, both passive and active, are attracting flows. In January 2026, ETFs saw estimated net issuance of $156 billion, delivering the strongest January start for the ETF market on record. This suggests some of the movement is also about vehicle preference, not just geographic or asset class decisions. It's worth noting, while equity funds saw outflows, bond funds had an exceptional January. Taxable bond funds brought in $91 billion, their second highest monthly intake on record. Municipal bond funds attracted $14.5 billion, pushing total muni fund assets over $1 trillion for the first time in 4 years. This suggests some investors aren't abandoning risk assets for cash, but rather rebalancing from expensive equities into fixed income with more attractive yields. So let's wrap this up with a balanced perspective. U.S. investors are pulling money from domestic stock funds at a historically significant pace. That's the fact. The reasons are multifaceted: elevated valuations, international performance, currency shifts, concentration concerns, and a reassessment of where future growth will come from. Does this mean you should immediately sell all your U.S. stocks? Of course not. That's not what I'm saying, and that's not what the data suggests. What it does mean is that a decade-long trend of U.S. exceptionalism and concentration may be giving way to a more globally balanced approach. International diversification, long dismissed as unnecessary, is being reconsidered as valuable risk management. Market cycles turn, valuation disparities eventually close, and portfolios benefit from periodic reassessment of whether current allocations still match the opportunity set. The most important takeaway: stay informed, understand the context behind market movements, and make decisions based on your own financial situation and time horizon. Not fear, not hype, just rational assessment. If you found this analysis helpful, consider subscribing. I break down complex financial topics without the sensationalism. And remember, this is education, not advice. Always consult with a qualified financial professional before making investment decisions. Thanks for watching, and I'll see you in the next one.